Earnings season is coming up, and so day and swing traders love to take advantage of the volatility that earnings announcements afford. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our trading desk utilize unique strategies to take advantage of the way that options respond to scheduled earnings releases. In this video, we're going to be discussing the details of a specific strategy that earnings traders like to use on equities that are about to release their quarterly earnings that I think is really intelligently designed and provides the potential for a quick win if you do a little bit of homework. So stick around if that sounds like the kind of trade you'd like to add to your playbook. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so with earnings season beginning shortly for this year's Q1, options traders gear up to utilize their earnings strategy, and one of those popular earnings strategies are known as earnings iron condors. The basic concept behind the strategy is that stocks make much larger moves than normal right after earnings are released for those stocks, and so the options market anticipates this larger than normal movement and pumps up the prices of the options derived from that stock, which expire right after the earnings are announced and are therefore exposed to the earnings release. Now, for you to understand why this happens, which is the key to how this strategy works, we'll need to do a really quick review of how stock options work. Now, most of you know something about stock options or what is known as equity options, but those of you who don't, we're going to do a very quick review of how they work and then jump back into the trading strategy. So hang in there. This is going to be fast. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at the strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute, make a huge profit on those shares in that case. And so at earnings time, this becomes a huge risk for the call seller because if this happens, in other words, if the stock rallies hugely off of earnings, then he'll have to sell his shares for much less than they're worth. And so taking this risk near earnings requires him to increase his charge for those calls to cover that larger risk. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much the buyer can lose owning that stock. And so again, this represents a huge risk for the put seller if the stock tanks after earnings, and the put seller is required to buy the shares at much more than they're worth, which causes him to take an immediate markdown in his account. On the other hand, if on expiration day, if the stock closes below the strike price of a call, unless it was previously exercised, the call expires worthless and the call seller just pockets the premium. And similarly, if you'd sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. And this last point is key to how this strategy works, as you'll see in a minute. With that as background, let's take a look at FedEx stock, the express mail and package delivery service. And as you can see, 30 minutes before earnings on March 18th, the stock was trading up around $264. So at this point, I want to give a shout out to Emily, who's on our options trading team and from whom this example is derived. You see, what Emily does is she takes a look at historical moves on stocks she follows after earnings, and she sells a short option at or around the prices that would be the equivalent to the largest price move the stock has made in recent times, right after earnings. So in this case, Emily, through her research sources, determined that FedEx tends to move less than 15% after earnings are released historically. And so her approach is to sell short calls and short puts at about that distance from the market. And so using her technique, which is very conservative because it's based on the largest move in recent times, we could move a little bit inside of that to say 35 points above and below the FedEx price at that hour, which was 264, and sell the 300 calls expiring the next day and simultaneously sell the 230 puts, again, expiring the next day. And then as protection, just in case the stock acts out of character and goes completely haywire, you would then buy the 330 calls and the 200 puts 30 points farther away from the stock price in both cases. And so this formation, short calls above the market, protected by long calls further above the market, and short puts below the market, protected by long puts further below the market, that entire structure is what is known as an iron condor to options traders. Now, before we get into how this iron condor trade played out, I wanted to let you know that if you want to learn the details of 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make more money on a stock or an index even if you're outright wrong on the direction, click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you do not want to miss this free webinar, so pause this video now and sign up before you resume watching. Okay, so now let's first break down the cash flow implications of this iron condor trade. And as you can see, selling those short calls brought in $480 in cash because they cost 48 cents per share, and each option represents 100 shares. So you multiply that by 100, and we sold 10 of those, so that resulted in that $480 cash inflow. For protection, we bought those 330 calls, and those cost us $80. And then we moved down to the 230 puts we sold, which brought in $160 in cash. And finally, we went ahead and bought those cheap puts down at 200 for protection, which only cost us $40 for a total cash flow from the iron condor trade of $520. Okay, now moving to the next day, we can see that the market must have liked the FedEx earnings report because the stock rallied to 280 and closed right around that price at 279.58. So let's now analyze what happened to our iron condor trade on this day when those options expired. Well, as you can see, the 300 and 330 calls expired worthless because the stock closed at 279, well below the strike prices of those options. Since no call buyer is crazy enough to buy the shares from you at 300 or higher when they're trading at 279, those call options just expire worthless. And the same for the 230 and 200 puts, because obviously no put owner would sell his shares at 230 or lower when they had just rallied to 279. And so all 4 options expire worthless, resulting in a final trade outcome of a $520 profit because the options have expired worthless. They're irrelevant, and you just get to pocket the $520 in cash that you originally received. Okay, now at this point you may be asking yourself, hey, so what does this trade have to do with earnings? I mean, couldn't I just do that same thing, sell an iron condor with a short call 35 points above the market and a short put 35 points below the market, surrounding those with long calls and long puts for protection? And the answer is you certainly could do that, but let's go back a few months earlier to January 14th with the apples for apples scenario. The options are expiring the next day in this example also on January 15th, and so we go 35 points out from the current market price of 256, selling the 290 calls and buying the 320s, then selling the 220 puts and buying the 190s. And do you know what we get for this fantastic trade? As you can see from the calculation involving options, the total trade produces positive cash flow of $30. And that's before you deduct commissions, leaving you with next to nothing if you're lucky. So why did we get $520 right before earnings and only $30 during a random date in January when nothing special was happening with the company? And the answer is that the earnings, the imminent earnings, pumped up the value of the options right before the earnings release. And so the trade becomes worthwhile, because as to the options that you sell, which are really the key to this trade, instead of getting 2 or 3 cents for them, the short call went for 48 cents and the puts went for 16 cents. And the long calls, which are a bit more expensive right before earnings, were still quite cheap compared to the short options, because they were 70 points from the stock price. And that's just a bridge too far for this stock to move, as Emily figured out from her research, which suggested more like 40 points was about as bad as it could get. And that itself is an extreme. And so while 16 points is a very large move on a stock trading around 265, it wasn't anywhere near as big as it needed to be to cause Emily to even break a sweat on this trade. And so what I'd like you to take away from today's video is that traders, like the guys on our desk and on our Options Tribe trading team, have the knowledge and the education to understand how options respond to impending earnings releases, and understand how to research the realities of the likely moves of the stock based on history and other forms of research that Emily conducts. And so you probably wouldn't be surprised at the very high win rates that earnings traders like Emily have, because they put in the hard work to understand their disciplines and reap the rewards of that hard work very frequently. Now, just to remind you, if you're serious about trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just go ahead on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to hit our subscribe button right now so that you don't miss any of our free training videos to help you to improve your game as an options trader.